Today we are discussing an interesting topic of lump sum versus SIP. There is a lot of literature available on this topic in the market and on internet, and you can go through. A lot of people argue that lump sum is better because it performs better than SIP over one period of time. Others will argue that SIPs are good because it takes care of the risk and it gives you peace of mind. But we need to look at the data, we need to look at the mathematics, we need to look at the scientific and real life examples of how how both of them have performed over time. And that's what we are going to do today. But before we start, my name is Narayan. I work for Standard Money and I am a certified mutual fund distributor. My ARN code is 82572. And this workshop is not just a disclaimer. This workshop is not to promote my services or to promote any specific mutual fund. We may have taken some examples of certain mutual funds, but those are not to promote them, but to just show you a real life example. And this PPT has been made using Notebook LM, but it is everything that is there. It has been only designed using Notebook LM, and summarize the research work and everything has been done by the team and shared on the notebook to create the final PPT out of it. Now, putting that aside, there are two types of capital deployment, or you can say investment methodologies. Some people like to invest in a lump sum in equity market. Some others will advocate using systematic investment plans. Personally, I would like to look at the data first before deciding, and whatever the data says, as you will also find as we move forward in this workshop, investing in a lump sum, investing a lump sum in the market or using a systematic investment plan basically depends on your own situations more than the choice that you have in the market. If you have a large amount of money to invest at this point of time and you want to invest in the market or in equity mutual funds, I would not say that no, you keep the money in your savings account and then let's start a systematic investment plan. I would say you invest that lump sum, but in a different manner. And we try to average out the risk of the equity market movement. If we don't know if the markets are crashed, if the markets have crashed previously and now in the recovery cycle, if you don't know that market is going to crash, which is obviously 99.99% of the time we will not know. If the markets are going to go up, if we know already, then it will not make sense to invest anything small. If we might just sell the house and invest everything in the equity market. But at any given point of time, most of the time we don't know. Then what we do, we try to minimize the risk of losing money. Because understand this, if I invest lump sum money, lump sum all the entire savings at one point of time and the markets go down, my fear is I will not only lose the current capital, but I will also do not have the money to invest more, which will average out my initial buy and give me a lower buying price. My average price will go down. This is what is possible with the systematic investment plan. So the strategy with both of the thing is, with the SIP is, you spread your risk of capital market going down over a long period of time. So your average cost of acquisition may go down. If the markets go down, your average cost of acquisition will be lower. If the markets remain same, then also SIPs do well. If the markets are going up, there is nothing that can beat a lump sum investment. So let's see how SIPs are going to give you the benefit. Is SIPs create rupee cost averaging. What is rupee cost averaging? Is when the prices are low and you are investing a fixed amount, let's say 10,000 rupees. The price is right now 5 rupees. You automatically get 200 units or 2000 units. But if the price is 10 rupees, you get only 1000 units. And the price again comes down. The price keeps fluctuating. At the lower price, you get more number of units. At a higher price, you get less number of units. So automatically, your average cost of acquisition remains below the average price movement of the mutual fund or the market. So this is why SIPs work very, very well when the markets are unpredictable. If they are choppy, they are consolidating, or they are going down. But what the real world data says. So last 20 years of Nifty 50, SIPs are winning over a 5-year horizon investment. SIPs are winning 52% of the time. SIPs are performing better than lump sum investments. But if you take 15-year horizon and you give a rolling period, a rolling return, then lump sum investments are winning 52% of the time. It doesn't mean we are talking about one point to one point, point A to point B. We are talking about point A1, point A2, point A3, and so on, and ending at point B1, B2, B3. So there will be about 704 rolling points of Nifty 50 between 2002 to 2025. So we started investment at point A1 with a lump sum and an SIP, and so on. We went up to point A704, and then at every 5-year horizon we are looking at where the SIPs are, where the lump sum investments are. So with a 5-year horizon, SIPs are winning 52% of the time. It's not much, it's almost the same. So SIP performance and lump sum performance are not very different over a long period of time. So where does the difference come in? Why is there a difference? The difference is between your income and your lifestyle and your own financial situation more than the market. So markets are going to perform similarly for SIPs and for lump sum investments, but you may not have a lump sum amount ready at any point of time, all the time, to invest. But if you are salaried, if you have a regular income, you will have SIPs most of the time. You will have a small sum of money, 10,000, 15,000, 20,000, even 1 lakh rupees that you can invest in the market every month. But if you are not salaried, if you are a businessman, if you have a business income, you have a windfall gain once in a year or twice, or maybe 4 times a year, then you can go for a lump sum investment. But what you want, whether you are investing SIP or lump sum, you want to minimize the short-term emotional loss. Why do I call it short-term emotional loss? We'll see. This is another proof of how the 5 years have performed. This is one point from 2020 to 2025. This will come back to this, but let's look at where the SIP performance, why you are not putting, even if you have lump sum, you are not putting everything in the equity market at one point of time. There are 2 assumptions here. One is we cannot predict where the market is going to be tomorrow. So I don't know if today it has closed at 23,000, tomorrow it will be 24 or it may be 22. Or over the next period of next 1 month, it can be anywhere. So you cannot predict the market. You don't know where it is going to go. So you will never be 100% sure that your money will grow or lose the capital, make losses in short period of time. In a long period of time, 5 years plus, it is going to be in profit. But the longer you wait, the more your chances are that you will end up with a profit in the market. But over a short period of time, there can be losses. So what we want is we want to minimize those losses. So we stagger the investments. We will make one investment at maybe at this point somewhere. Another investments will go at this point. Another will go at this point. So what you are doing is you are lowering your average cost of acquisition. With your first investment, your cost of acquisition was somewhere at this point, a very high cost. But with the second investment, your average cost comes down to this place somewhere. And since you are buying more number of units at a lower price, your average price will be even lower, closer to your lower price, lower acquisition price. And as you continue to purchase at different points of time at lower levels, you will find yourself with more number of units that you could have purchased at this level. But since markets did not perform that well, you now have lot more units in your pocket than you could have afforded at this point of time. So what will happen when markets recover? You will quickly regain your portfolio value. You will quickly come into profit. So you see, in the previous bull run, what we call from 2020 to 2025, in the bull run, Lumpsum did perform really well. It gave 22.11% return CAGR, whereas SIPs gave you only 13.46% return. Why? Because a lot of your money that you invested later, that came into the market later, lost the initial momentum. So you will earn a little less when the markets are bullish. But when the markets are bearish, SIPs work wonderfully. As you can see, lump sum return was 7.44%, whereas SIP return is consistently going on at 11.53%. So what we are trying to do is remove or reduce the value at risk with the SIP risk. So loss aversion is one of the common traits that we have. We want to avoid losses. A lot of us, I'm not saying all of us, but a lot of us want to avoid losses more than we want to feel the joys of profits. So, and most of the time you will see that if you can manage the risk of loss, the the better you can manage the risk of loss, the more your chances of gaining out of it, out of your investments are. So, and that is a kind of, you can say, universal law that follows. It's a part and parcel of our life. So if we can manage the risk, we can enjoy the returns, and that's what this SIP allows you to do. But if you can, maybe you are those 1% or 2% people who can predict the market and tell whether it is time to get into the market full throttle or not. If you can do that, you are welcome to invest. Also, you should have that large sum of money to invest at one point of time. If you are a salaried person or you have a regular income, maybe SIP is still a better choice for you. It will not destroy your sleep at night. So the across 10 years, 10-year rolling period, what our research says is over a long period of time, the difference is not that much. So if you, whether you go for a lump sum investment or whether you are investing in SIP, you are basically not changing or let's say not going to lose much or not going to gain a lot by using a lump sum or just following an SIP. Your returns will remain almost consistent. It's just that SIPs will give you a lot less sleepless nights. In fact, you can sleep really well with SIPs, not that well with the lump sum investment, unless you have continuous gains, like every quarter or every half year you have a good amount of money that you can invest in the market. So what we do, with the lump sum, even if you have a lump sum amount, how do we, as mutual fund distributors and advisors, how will the professionals invest your money to make sure that you can sleep well at night and still enjoy the fruits? Is we'll invest the lump sum in the liquid or debt fund, and then we start a monthly fixed amount that will transfer to the target equity fund. And this can be done at a, depending on the amount of money you have. It can be staggered up to 1 year or maybe 6 months or 3 months. So what it is doing, it is removing the short-term possibilities of loss from the capital. It is also, it is distributing the risk over a long period of time. It is also not going like for 5 years your SIP is continuing. It's not also not like that. So if you look at 10 years period in a market, your investment will be just a point at 1 year time, like 6 months time or 12 months time at max. So even if you are going with a lump sum, you have an option for STP. So this is again, I would not say that it is possible all the time. Like the current situation is you are not neither on the left nor on the right. So it's not like markets are at all-time high. It's not like markets have crashed and we are like there is a bloodbath. There has been a bloodbath and now markets are recovering. It's just that there had been a small correction because of global factors and lot many things that have happened around the world. And markets will recover anyways. And there will be new all-time highs and there will be new downtrends in the future. But right now, we are neither on the left nor on the right. So the best thing to do, if you do have a lump sum, again, if you have a lump sum, we'll do an STP. If you do not have a lump sum, SIPs. At any given point of time, you can start an SIP, and that will take care of everything, whether the market goes down, whether the market goes up. And one more thing that you need to remember is that if you are investing in equity market, keep your time horizon long, like 3 to 5 years at least at a minimum. You should have before you need that money or before you try to withdraw the money out of the markets. After 3 years, you can start gradually withdrawing equity market if your goal horizon was 5 years. So after 3 years, you should start withdrawing gradually. That is also possible through an STP from instead of liquid fund to equity market, we run a reverse STP from equity market to a liquid or debt fund. That way we can save all the gains that you have made in the past 3 years, 3 to 5 years, and also not miss out on any future rallies in the next 2 years. So how do we decide whether to go for a SIP and lump sum? I think you have already understood. There is no, it's not either or, it's what you can use and how you can use it to your advantage. And not only advantage, to also continue to have a good sleep at night and not lose it because of your investment choices. So first thing is the nature of capital. Still, let me repeat it once more for everybody's understanding. Is first question is nature of capital. Like if you have a regular income, SIPs are the best possible thing. It's also more about understanding yourself, and if you are just starting to invest in the market, SIPs are better because SIPs take away your stress, and it gives you it keeps your mind free from all the stress of whether your money is performing or not, whether the markets are going to eat your money or whatever. You can focus on your employment, which is going to give you better growth opportunities, better income, and your income continues to grow for a long period of time. Second is the time horizon. This is very important. As I said, you need to keep your time horizon longer if you're investing in equity. 3 to 5 years, I say, for a very aggressive investor. But in general, if we talk about a long-term horizon, 5 years plus is what you are looking at. Also, in some other workshop, we'll discuss about the market cycles and everything, how the 6 year cycle is have been observed in the market trends, and what is the 12-year cycle or 15-year cycle that you can look at. But if you're investing in equity funds, equity markets, keep your horizon 5 years plus. Also, what is your regret tolerance? We call it risk appetite also. If you can digest a 20% drop in your investment portfolio, welcome to the equity market. If not, keep your equity exposure lower. Also, all the rules, these numbers that I'm sharing, although we have capped it like 20% drop, 5 year horizon. So these are not a rigid criteria. These are basically, you can call it general criteria. But if you want to know what is specifically applicable to you, you may feel very um, not shaky about 20%. You may be comfortable with 50%, but that's your personal choice and personal risk profile. And you can discover it with us if you want, or you can contact with your get in touch with your financial advisor to give you a detailed risk profile. Then number four is market reality, which is very difficult to guess unless you are completely full-time invested in the market, like a fund manager. And that is why we rely more on mutual funds than our own judgment, because mutual funds have professional managers like fund managers who are very experienced and qualified to look at the market and tell what is exactly going on. So how will you execute investment? This is a general blueprint. It is a simple process that we apply anyway for any kind of investment. First, we try to define the goal that you are targeting. If you want to achieve, or if you are investing for retirement, if you are investing for 5 years to purchase a house or whatever, because every goal has a different emotional value and emotional value attached to it. So accordingly, your priorities will vary. And then we try to segregate the kind of investments that you have. You may have lump sum from other investments if you have already been investing that you want to park in equity mutual funds, or you want to switch from one type of investment to the other type. And that's where we segregate and we create a diversified portfolio of different types of investment. And then we try to automate the investments as much as possible. So all the regular income investments will be automated through SIPs. But if you have a bonus once in a year or twice in a year, that bonus can be looked at and allocated some to your lifestyle and a large part of it to your investment, so that you remember that this year I got that bonus, that kind of bonus, so it is still there, it's growing. So what we want at the end of the day is we want to remove the emotional, basically detach our emotions to our investments. We want the money to perform regardless of how we are feeling about it. So that's it for today. Thank you very much. And in the next presentation, we'll be discussing how to exit the financial market. Entry and exit are the two only important points. In the middle, it's the journey. So journey is anyways, once you are in, you will take. But exit is once you have onboarded the train, the next important point is the exit point. So let's discuss that